how to save money and what we can do to save money, save tax. So, very interesting topic. Let me give you a little introduction. First, we have Pooja, who is administrating this session. Then I am Vijay, CEO and co-founder of 99 Home. We are into sales, that management, auction, whatever you name in property, we do everything. Then we have Sid Agarwal. Sid is from DNS Accountants and one of the most promising, I would say, tax consultant. Sid is. So, Sid, I would suggest you to give your introduction by yourself. I think you can do a better job.
No, thank you, Vijay. Good evening, everyone. So, just to introduce myself, I'm Siddharth Agarwal, Chartered Tax Advisor in ACCA. I'm a Senior Tax Manager at DNS. So, DNS was established in 2005, and we are CMI accredited accountants. We work with more than 13,000 clients, over 28 offices across the UK. And my specialization is mainly owner-managed businesses, property tax, and succession planning. I've been working in the tax industry for the last 10 years and with a special interest in property tax.
Perfect. Guys, this is an interactive session. If you have a question, please help yourself. Just write the question on Q&A, the panel. So I will try my best to accommodate all the questions. Let's crack on. Talk about tax, actually. Very interesting topic, as I said. As a landlord, no offense, all governments want to take advantage of. They see somebody is making money, so how to make money, how to take more tax from them. So the way they charge you, sometimes you feel it is genuine, but sometimes you feel this is not the correct. For instance, in property sector, you had some time back, you had maintenance work. You could have you was able to basically claim those back money, but not anymore now. So government changing, so tax and implications changing. I'm passing session to Sid.
Yeah.
He will explain more.
No, perfect. Thank you, Vijay. So let me start by saying that property tax has become an increasingly complex area. And I think over the last 8 years, as Vijay mentioned, the government has attacked the letting industry with a raft of new provision designed mainly to make this activity less attractive. Now, if you look at some of the major changes, I think the first major change was abolishment of the 10% wear and tear allowance. Obviously, that was replaced by the less attractive domestic item replacement relief. Then they introduced a 3% stamp duty land tax charge in purchase of second properties. When they were bringing down the capital gains tax, I think the CGT on residential property remained to be at 28%, when it was reduced to 20% for other assets. And then we saw the finance cost restriction for individual landlords. So you can no longer deduct that as an expense, but you get a less generous 20% tax credit. And then most recently, from 2020 onwards, we have seen two major changes. One is as soon as you dispose of a residential property, if you're a UK resident and if you dispose of a residential property, you have to pay the tax in 30 days when they initially started. And it was then extended to 60 days from October 2021. And then finally, the lettings relief. So letting relief was possibly before the letting relief was available for anyone who occupied the property as a main home, and later on they rented out the property. But from April 2020, it's only restricted to landlords who are occupying the property with the tenant. So if you look at the life cycle of a landlord, there are three basic situations where the taxation is probably going to impact them. The first is when they acquire the property, they have to pay the stamp duty land tax. And again, we've already, as I mentioned, the 3% surcharge applies. Unlike where you're buying a property as an individual, you don't get the If you're buying the property as an individual, you may be entitled to first-time buyer's relief, etc. But then, if you're buying the property in a limited company, especially, you're not entitled to any reliefs. You have to pay the 3% surcharge, which applies to purchase of second homes. Then, if you look at the later years, whenever you're receiving rent and you're incurring expenses, that's when you'll pay tax on your income that you're generating from your property portfolio. And again, that's been restricted significantly, because if you look at the major cost, or we all have to accept the only major cost a landlord has is the interest that they pay on their rental income, but that's again has been restricted. And then once you dispose of the property, at that point of time, you'll have a further capital gains tax liability. So technically, you have three basic situations, and let's not forget, probably on your death, the estate has to pay inheritance tax as well. But although there have been so many changes, still, I think property investment still seems to be very popular amongst investors, because one of the surveys that we saw from the English private landlord survey that did mention that 42% of the landlords, or more than 40% of the landlords, they preferred property to any other investments. And then 35% of the landlords, they became landlords so they can supplement their main earnings, basically to gain financial independence. So for today's discussion, I think I wanted to keep the main focus towards the strategies you can adopt to mitigate the impact of Section 24. And then we can look at how you can transfer the existing properties into a limited company. I know there's been a lot of talk about people purchasing properties to a limited company, how you can optimize the tax. And I think the first question that comes in is, how can I transfer the property to a limited company with minimal tax implication? So looking at the interest relief restriction, going back to my accounting days when I was first as a student, the first principle I was ever taught was revenue less expenses equals profit. But I guess that's not the case anymore, especially for landlords. Although income will be classed as revenue and interest is an expense, but interest is no longer deductible as an expense from your rental income. Instead, you actually get a 20% tax relief, which is not very favorable if you're a 40% taxpayer or 45% taxpayer, because technically then you're losing out marginal relief of 20% or 25% if you're an additional rate taxpayer. And this restriction came at 100% from 2021. So from 2021, landlords only receive 20% tax relief on the interest element. And I guess this will start biting now when the interest rates have gone up. So we've already seen the Bank of England has increased the rates to 5.25%. Some people may have fixed interest that they may have agreed before these changes came in. But once they get to the stage of remortgaging, probably you're going to end up paying 6%, or in some of the cases, you've seen 8% as well, depending upon your portfolio. So this definitely will have an impact as far as your cash flow is concerned, because the disallowed interest portion can have three possible impacts. One is you could lose your personal allowance. If you already have employment income, self-employment income, or other income coming from other sources, you will definitely lose your you could lose your personal allowance. If you're claiming child benefits, your income could go above £50,000, which means your child benefits can be restricted. And as I said, a negative cash flow is what we are seeing for a lot of landlords. The first thing to check is how big is the problem, because it's very important that you look at the numbers, you do the calculations. If you already have an accountant, ask them to do the calculations and see how it impacts your property portfolio. In some cases, especially if you're retired, you don't have other income, then probably the problem may not be as big as you may think. But again, if you have the objective of growing, then definitely it could become a problem sooner or later. So in order to tackle the Section 24 impact changes, there could be some mitigation strategies that can be sought through. The first thing you could do is make personal pension contributions. So if you have a financial advisor, probably speak to them and see if you can, if you're already making pension contributions, you can do additional pension contributions. So that will increase the basic rate band that you have, which would mean you'll end up paying less taxes. Secondly, if you're doing any charitable donations, it's better ensure that you're claiming that in your self-assessment. The third thing you could look at is paying down the borrowing. So if you have a very highly leveraged portfolio, if your pocket allows, then paying off some of the borrowings could be beneficial, especially when the interest rates are so high. But again, we all have to agree that leverage mortgage or commercial loan basically allows you to leverage, which means you can grow your property portfolio much quicker. But then given that the interest rates have gone up, probably if you do have an extra cash sitting, then it might be worthwhile seeing if you can pay down some of the borrowings to reduce the interest cost. Increasing the rent, again, that depends upon the commerciality. So you could always think about increasing the rent. We all know that the rents have gone up now. There's a shortage as far as the rental market is concerned. There's less supply compared to the demand people have. So increasing the rent could definitely have a little bit of positive impact on your cash flow. Then one more thing that you can look at is probably converting the use of the property. So at the moment, if it's a buy-to-let property, let on assured short-term tenancy AST, then you have that, you basically have the interest rate relief restriction thing. But then the interest relief restriction doesn't apply to properties which are let out as a service accommodation or holiday accommodation or furnished holiday let. So any property which is being let out as a furnished holiday let or serviced accommodation, they're still eligible to deduct the interest from the rental income they're receiving. And then these properties, they have other tax benefits, like you can claim capital allowances. When you sell the property, you could be eligible for business asset disposal relief, which means you pay 10% tax instead of 28% tax when you sell the property. So that's something that you can think about, or maybe a change of strategy where you buy more commercial properties instead of residential properties. But then again, the solutions that I've discussed, I think they're less practical. But going on to the practical solutions which could have a proper tax impact is splitting income with a lower tax-paying spouse. So if you're married or if you're in a civil partnership, yeah, and if you have a spouse, a civil partner who's a lower rate taxpayer, then technically you could split some income with them. HMRC's default position is if you're holding the property is jointly or tenants in common also, the default position is the income from the property has to be split 50-50. But then using a form called Form 17, you can actually decide how you want to split the income. And again, you have to do the calculations to see how beneficial it can be. So rather than splitting the income 50-50, you could transfer 90% or maybe 99% to a lower tax paying spouse, which would mean that overall you can optimize your tax position. The other option that you can see is a property management company. So a property management company set up, the cost of managing the property could be transferred to a limited company. So how that could work is the company will have a contract with you where it fully manages the letting business. The company will deal with collecting rents, managing tenant queries, repairs, full maintenance of the property like a letting agent. And in return, they would charge you a fee. The fee, again, has to be on a commercial basis. As long as it's on a commercial basis, then definitely you can reduce some of the profits that you are generating from your rental activities, which will go into a limited company, which pays, which will mostly pay tax at 19%. The other option that you have is partnership. And so if you have family members or your spouse, you can think about setting up a partnership, which could be a general partnership or a limited liability partnership. The key benefit with a partnership is the profit or losses can be shared between the partners with a mutual agree. They can decide how to split the profits of the partnership from time to time, and they can agree between themselves how the profits needs to be split. But again, with the partnership, the one thing that you have to remember is it has to be a business. It has to have considerable activity in order for it to be classed as a genuine partnership. Then finally, a use of discretionary trust. So if you're thinking about inheritance tax planning, some of the properties, if they are sitting with a large gain and you're not comfortable transferring this to your children, for example, because you may be hit with a capital gains tax liability, then using a discretionary trust or something which could work out. With a discretionary trust, the property can be transferred into the trust, and then there is a particularly very generous relief which is available called the gift holdover relief, which means when the property goes into the discretionary trust, there's no capital gains tax for you to pay. The only downside is this would only apply if you don't want to benefit from the rental income, because from the day you transfer the properties into the trust, the rental income will be mainly passed on to the beneficiaries, which, as I said, could be part of your inheritance tax planning as well. But as I said, probably that's a discussion you need to have with an accountant or a tax advisor to see how beneficial it can be. Then the final solution is limited company. Now, with limited company, Again, the key benefit is, first of all, the limited company is allowed to deduct any interest that it's paying. So unlike individuals or partners in a partnership where you're no longer allowed to deduct the interest, any interest expense which the company has, the company can still deduct this as an expense from its rental income. So definitely there are a lot of savings as far as interest relief restriction is concerned when you're buying a property through a company. Then with limited company, there are always opportunities to plan your taxes well. So it allows you to flexibly withdraw your income. For some people who don't really who are not really using their rental income for day-to-day use, they could literally leave the funds into the company, and that funds can be then used to reinvest into other properties. So if you don't want to benefit from the rental income, the company just pays corporation tax, and then the reserves can sit into the company. From there, it can be used to purchase more properties. With companies, again, the expense management can be better. You can add family members if you like, so children, spouses, and plan for IST as well. So a lot of ideas have been discussed about family investment companies. So it's just that with companies overall, the optimization of allowances and taxes are much better as compared to an individual. The single biggest challenge is especially for landlords who already have properties in their existing names. Transferring the property to a company will definitely have a lot of tax challenges. So there are two taxes which come into play. The first is the capital gains tax, and then the second is stamp duty land tax. Now, looking at capital gains tax first, I think when you transfer the property to a limited company, the company is deemed to be connected to you. So whatever price you use, the property will still be considered as transferred at market value or sold at market value. And in order to mitigate the impact of capital gains tax, you do have allowances. So if you look at the annual exemption amount for CGT for this year is £6,000. So between a couple, that increases to £12,000. It's going to reduce to £3,000 next year, which means from next year, a couple will have a £6,000 allowance. The other thing is the property that we're talking about was your home at some stage, then you could still claim principal private residence relief as far as CGT is concerned. So there are ways to mitigate the impact of capital gains tax, see what expenses you've incurred in the past. If you've made any capital improvements to the property, those can be deducted from the chargeable gains. But if the property has been used as an investment property, then again, there will be some CGT for you to pay, and a computation is definitely required there. But again, given the current market, there's been a lot of reduction as far as the property prices are concerned. So you may want to obtain a proper valuation from the estate or from an estate agent or a surveyor to see what your property is worth, and when it goes into the company, what sort of capital gains tax you may end up paying. Now there are reliefs called there is a relief called incorporation relief which could apply as far as capital gains tax is concerned, which I will cover in a bit. The other thing is that when you transfer the property into the company, the other tax that you have to pay is stamp duty land tax. Now, I know there's a misconception that when a property is being transferred to the company, if the company is not paying you anything, then technically stamp duty land tax shouldn't apply. But that's not the case. There is something called deemed consideration rule, which is contained in the Section 53 of Finance Act 2003, where majority of the SCLT legislation is to be found. When you're transferring the property to a limited company, the market value rules apply, which means even if the company is not paying you any consideration for the property, you still have to pay the stamp duty land tax at market value. So which means even if you don't receive anything in value from the company still has to pay stamp duty land tax. Now, for stamp duty land tax, again, there are opportunities for you to kind of mitigate the stamp duty land tax. And so, for example, if you're holding the properties in a partnership, and from a partnership, if you were to transfer the properties into a limited company, then there is a whole legislation on partnership called Schedule 15, where there are certain exemptions available, especially if the if the shareholders and the partners in the partnership are same, then technically under Schedule 15 you do have relief available. Now it's not exactly a relief, but it's basically a calculation that we do. And in majority of the times, if you are connected, even if you have mortgages on the property, the deemed consideration, which is the market value rules which you are looking at, comes out to be nil or nothing, which means you can easily transfer a property portfolio from a partnership to a limited company without paying any stamp duty land tax. And then apart from that, there are certain other reliefs available as well. So if you've got multiple properties, you can think about claiming multiple dwellings relief. If you have a property portfolio which contains residential as well as mixed use, residential as well as commercial properties, then technically you can apply the commercial rates with multiple dwellings relief, which means the STLT could be significantly lower. So I think the point that I'm trying to make is it's important to plan the transaction. So as long as you plan the transaction, look at the numbers. If you have a business case where the properties can be transferred into a limited company, albeit with a little amount of capital gains tax and STLT, and let's say over the period of next 5-10 years, if the savings that you're going to make in terms of income tax is significant, then there's still a business case for you to transfer the properties into a limited company. And then I guess the only last thing is when you're transferring the properties into a limited company is you will incur legal costs as well. So you need to add up the legal costs as well to see whether it's beneficial for you to put the properties into limited company. So I think that's how it would work. Now, going back to the incorporation relief, so as I said, if you are a landlord who's basically got significant amount of properties, you're spending a lot of time managing these properties, and you do have a significant portfolio, then there is a very valuable relief called incorporation relief under Section 162, which could be claimed, which basically means you can transfer the entire portfolio into a limited company without paying any capital gains tax. Now, again, in order to claim the incorporation relief, there has to be a business, and it's mainly the degree of activities that you do as a whole, which is important when we consider whether the incorporation relief will apply to you. So it's not really based on number of properties or number of properties, but we have to consider the situation as a whole. How much time you're spending managing these properties, what is the turnover of the properties, and these kind of things. So as long as we do have a business case where we can prove that the activities that you're performing are substantial and it is an actively managed business as opposed to a passive investment business, then technically incorporation relief could be available. I think one of the examples could be even if you've got 10 properties, all the properties are being managed by a letting agent, then it's highly unlikely that you will be eligible for incorporation relief. But if you're actively managing your property portfolio, dealing with the tenants, looking after the repairs, maintenance, spending considerable amount of time undertaking these activities, then there is an indication that you're involved in a business and an actively managed business rather than a passive activity. But the incorporation relief only applies to capital gains tax. It doesn't apply to stamp duty land tax. So again, but with stamp duty land tax, as we saw, there is a possibility of basically transferring the properties from a partnership into a limited company and that's where you could get the stamp duty land tax relief. Or even if you want to transfer the property directly, we just have to see what kind of reliefs you can claim. So things like multiple dwellings relief, or if you have a commercial property, then the STLT liability could be significantly lower as compared to directly transferring them into a limited company.
Perfect. Thanks, Sid.
Yeah.
You have given very good information. I'm just directly jumping on some questions. Guys, if you have any question, either type or just raise your hand. There is a button on your screen, hand button. Just click on that. Then I will come to you and you can ask directly. There's a question here. Is probably no forward answer. But if you are already in a high tax bracket from your normal day-to-day job, and if you have a small property portfolio on your personal name, what is the best way to save tax?
Yeah, I guess the first thing to look at is how you can optimize your expenses. So are you claiming all the expenses that are wholly and exclusively incurred on your property portfolio? Obviously, we have seen that interest is one of the biggest expense that you may have as far as your property portfolio is concerned, but then that expense is not allowable. But if you've got other expenses such as, so for example, if you're regularly managing your property portfolio from your home, then you can claim use of home. If you're traveling between properties, there's a possibility for you to claim travel and subsistence expenses or motor expenses. Then we talked about domestic item replacement relief. So if you're replacing any items which are there on your property, which will be used wholly and exclusively for letting purposes, then that's something that can be used to reduce your expense. The other thing is professional subscription. So if you are tied up with, for example, if you're paying subscription fees to NRLA or NRLA or SAL, then technically these kind of subscription fees could be reduced, from your property portfolio. And then for costs like phone, if you're paying any utilities or council tax on behalf of your tenants, especially for HMOs, then these kind of costs can always be reduced from your property portfolio. So I think the first thing to see is optimization of you're optimizing on all your expenses. Second thing is, depending upon your property portfolio and if you're married, then as I said, probably a Form 17 where you can start splitting income with your spouse or civil partner is something that you can consider. Third is there's a possibility if you've got other family members, probably setting up a partnership where they can club their property portfolio, or maybe if you've got children who can be partners in a partnership, you can bring them in as well and see how we can optimize the overall tax. And then then we can possibly think about a property management company where a company could be set up to kind of look after the overall management of your rental property portfolio. So there are things definitely to consider. But as I said, the first thing to see is how much is the impact as far as taxes are concerned, and see if there's a business case to transfer the portfolio into a limited company. Even that option is available for you.
Perfect. Beautiful. Thanks, Sid. My next question from Human Chain. Depending, sorry, Manoj, I will ask your question after this one. Depending on the size of portfolio and degree of activities, you can consider incorporation relief section 162.
Yeah. So I think what they're trying to say is for incorporation relief, which is the capital gains tax relief that we were talking about, depending upon how many properties you've got, I think, as I said, the number of properties is not important. It's the degree of activities that you undertake is relevant here. So if it is an actively managed business, that's when we could think about claiming incorporation relief. Because all I would like to add is with incorporation relief, I think up until 2017 or 18, we could get a formal clearance from HMRC where we could write to HMRC, tell them what the activities we're performing, and then HMRC could agree whether the incorporation relief applies in our case or not. But that's no longer the case. And so if we are applying for clearance, HMRC basically directs us to the guidance which is available on their website. And there's a significant risk involved, because if you're claiming incorporation relief when you're not entitled to, that would mean you may end up paying significant amount in capital gains tax. So as I said, probably it's better to use an advisor who has experience in dealing with incorporation relief before you decide to go down that route.
Thanks very much. Manoj Talwar, could you can ask your question, please?
Thanks. You mentioned that if the property is jointly owned by couple, then the higher rate taxpayer can transfer to lower. If it's owned by higher rate taxpayer only, not in jointly, can still be transferred.
Yeah. So what you could do is you can have a declaration of trust to state that although you're holding the legal title of the property, the beneficial title of the property could be divided between you and your spouse. And so let's say a declaration of trust would simply say that you're holding the properties on behalf of yourself and your spouse, and the rental income will basically be split in the ratio that you desire. So maybe 90% could go to a lower paying spouse, 60%, 70%, whatever ratio you decide. But you need to have formal evidence, because if HMRC opens an inquiry, they would want to see that the other person whom you're splitting the income with is beneficially entitled to this property. And then what we normally recommend is, if you're receiving rents, probably have a joint account with the spouse, or probably just share the income in the spouse's account to ensure that there's no challenge as far as the revenue is concerned. But yeah, you need to have a formal document in place as far as HMRC is concerned.
When you say formal document, you mean Form 17?
So Form 17 is something which goes to HMRC. So with Form 17, so if you already own a property with your spouse, for example, if you're holding the property using as joint tenants or tenants in common, then what then HMRC's default position is that you're splitting the income. You have to split the income 50-50. Form 17 has to be submitted with HMRC whenever you want to split the income in a different ratio.
Okay, understood.
Yeah.
You said interest. What is the meaning of interest? So, interest not being deducted. What do you mean by interest? Sorry if it's a silly question.
No, that's totally fine. So what we're trying to say here is, if you look at if you look at a normal business, any business which is receiving revenue, any expenses that the business has. So, for example, if the business is having a revenue of £100,000, any cost that they are incurring on behalf of the business, they can reduce these expenses from the rent from the income they're receiving. So, for example, if the business has 20,000, so if they've taken a business loan, for example, and the interest that they're paying on the business loan is, let's say, 20K, then actually the net profit is 80,000 because this 20,000 can be deducted from the 100K. Whereas for landlords, you cannot deduct the interest anymore or any finance cost that you're paying on your rental property portfolio. You're no longer allowed to deduct this. So what happens in principle is, on the 100K will still be considered as your revenue or your profit instead of the 80K. On 100K, you will, if you're a high rate taxpayer, you'll end up paying 40% tax on it, for example. And then on the interest element, you only get 20% tax deduction. So if I was to compare this with a business owner, their tax liability on the £80,000, assuming that they pay 40% tax, let's forget about the bans or anything or other release for now. So on straightforward £80,000, their tax liability at 40% is going to be £32,000. Now, if I was to compare this with the landlord, although the interest is an expense for them, the interest is no longer allowed to be deducted as an expense. So their profit basically becomes 100K, which means the initial tax liability is going to be £40,000 on this 100K, 100 into 40%. And then whatever interest they're paying, they are only allowed a 20% deduction on this, which means on 20%, on £20,000, they'll get another 20% tax deduction, which is £4,000. So if you look at the overall liability, the tax liability was £40,000 plus minus the £4,000 that they can get on their interest relief deduction, which means the tax liability is now £36,000 as compared to the business owner who's only paying 32K on their business profits.
Thanks
So
a lot.
so because of this change, I think the landlords are technically worse off because ultimately interest is a major expense as far as your rental property portfolio is concerned.
Yeah.
Thanks, Sid. I have a question from Govind.
Yeah.
Govind, please go ahead.
So if I have a self owned buy to let, and how does the lease of property works? Can you explain me? I mean, I know I can lease it the property to someone. Can I lease it to a family member, like a spouse?
So you can lease it to a family member, but then I'm still a little bit confused. So so it's ultimately your property. You can
Yeah.
do whatever you like, but if you're leasing out to this family member, are they going to pay you rent or?
Yeah, of course.
Okay. So you're talking about leasing it to the family member and
No, I
then.
mean, I'm just looking at the saving some tax. So if I lease it to my wife,
Mhm.
will she able to, and she will manage the property and make whatever expenses claim on that
Yeah.
part.
Yeah.
Is
So
there
I
any
think
beneficial or not?
no. I think so. Ultimately, you're better off using a structure where you can actually jointly own the property or own the property as tenants in common, and then split the income between yourselves. I think that would be a better strategy as opposed to
Okay.
leasing the property to your wife and then she further leases the property to someone else or rents out the property to someone else. Probably a simple strategy could be to kind of split the profit between yourself and have proper documentation between yourself to show how these rental income will be split. Now, when you're transferring the property to your spouse, again, any transfer between spouses and civil partners will happen at no gain, no loss, which means there's no
Mm.
capital gains tax for you to pay. The only consideration is stamp duty land tax. But with stamp duty land tax also, if your spouse is not paying you any consideration, which will normally be the case, then there's no stamp duty land tax to pay. but we have to be careful about if the property mortgage, then any mortgage which is there on the property will be considered as a deemed consideration. So just to put some numbers into context, if your property is worth, let's say 500K, you go off 250K outstanding as a mortgage, and tomorrow you decide to transfer 50% of the beneficial interest in the property to your spouse, then technically the 150% of 250,000, which is the outstanding mortgages, will be 125K, which means that will be considered as a deemed consideration as far as stamp duty land tax is concerned. But the good part is the stamp duty land tax threshold is £250,000. And even if your spouse owns another property, any transfers between husband and spouse, the higher rate doesn't apply, which means there won't be any stamp duty land tax for you to pay.
Okay.
Perfect. Thanks, Sid. Manoj, I will come back to you after this question. Rural Handmaid have asked one question. Do you have to submit the Form 17 with HMRC for the lower tax paying spouse, or this is a part of a internal agreement?
Yeah, so the Form 17 has to be submitted with HMRC. So you will have to submit the Form 17 with HMRC, and HMRC would like to see some evidence as well to see that the beneficial interest is held in the ratio in which you want to split the income. So if the property is owned jointly, for example, where you both own 100% property, but for tax purposes, you have to split the income 50-50. HMRC would want to see a declaration of trust or a similar document or some evidence to show that the beneficial interest in the property or the legal interest in the property is actually held in the ratio in which you want to split the income. And it has to be submitted with HMRC. And the submission needs to happen within 60 days when you decide, when you actually create this document or declaration of trust, or from the day you decide how you want to split the income. This has to be reported to HMRC within 60 days.
Perfect. Mohit question, if you have a property via limited company, then whatever your income after tax, that you can transfer it from company account to personal account.
Yeah, so how a limited company works is whatever rental income the company will generate, the company will have its own expenses, and after that, the company will be left with the profit. This profit will be subject to corporation tax. The corporation tax is 19% if the profits are £50,000 or less. If the profits are more than 250,000, then the corporation tax rate is flat 25%. After the company has paid the corporation tax, whatever reserves or profits are left, that is something which can be distributed to the shareholders. And when you're transferring these profits to your personal account, they will be most likely they'll be classed as dividends. And on this dividends, you will have to pay personal tax as well. If you're a basic rate taxpayer, the tax is going to be 8.75%. If you're a high rate taxpayer, the dividends will be taxed at 33.75%. And if you're an additional rate taxpayer, the tax will be 39.35%. For dividends, you do have an allowance. So this year, the allowance is £1,000. From next year, the allowance is going to be £500. So which means after the company has paid its corporation tax, you can still take £1,000 as dividends, which will be completely tax-free. Anything that you take more than £1,000, you'll have to pay tax based on your marginal rate of tax.
Perfect. Manoj, please go ahead with your question.
Sure, thanks, Vijay. My question is, like, I have a property as of now, it's on personal name, and I need to move it to a company, but probably I might be selling it rather than like moving the property to a company accounts. So if I sell this property and like I have got money from it, like for example, £400,000,
Yeah.
and if I set up a company, how would that work? Do I need to loan that amount to the company to buy a new property? How will that structure work?
Yeah. So Manoj, when you will transfer the property to the company, the company will the company wouldn't really have the cash to pay you the 400K, which I'm assuming is the market value of the property. So there are two ways of transferring
No,
the
I'm not
property.
transferring the property. I'll sell the property. So
Yeah,
what's the
yeah.
better option, to sell the property and then use the cash to loan it to the company, or just transfer the property to the company and then sell it via the company? What option will be better?
Yeah, so technically, when you transfer the property into the company or you sell the property to the company, you will have a positive director loan account, which means the company will now owe you £400,000, which is the market value of the property. And then most likely the company is going to rent out the property. After the company, once it rents out, it'll pay corporation tax on its profits. And after the corporation tax is paid, whatever profits are left, the company will basically start repaying the loan. Any repayment of loan that you get from the company will be tax-free. Yeah, so it's better
Okay.
it's better to transfer the property as a direct loan instead of transferring it as an equity. Because with equity, if you're transferring it as an exchange of equity, then the only benefit that you will get is when the company has profits, then it'll distribute dividends, but these dividends will be taxable. So it's better for you to kind of transfer the property and create a positive direct loan account, which you can start withdrawing once the company starts generating profits.
So Sid, like
And
it's
that's the same thing also.
small-
Like even if you sell it separately, and I've got a cash in my like personal account. So and if I open a new company, a
Yeah.
property company, I can loan that amount to company as well. Like the same thing. Both are
Yeah,
same.
exactly. Yeah. So if you're looking to sell the property, if you don't want to keep the property and you're looking to sell the property, then perhaps you're better off selling it directly from yourself, because ultimately the capital gains tax liability is going to be the same, whether you sell it to a company, whether you sell it to a third party. And then with the company, the challenge is going to be you can then take the cash and then probably open a limited company, make it a family investment company, put this money as a direct loan, and then you can go ahead and buy assets. With a family investment company, you can add your children, you can add your spouse, and optimize your IST position as well.
Sure. And how does this holding company fit into the picture? Like I've seen a lot of people using the holding company.
Yeah.
Would
So
it a
holding
simple
com-
structure to follow or complex?
yeah. So holding company, we normally recommend holding company structures when you're going to have multiple activities as far as your business is concerned. So for example, if you've got a separate business and the business is basically sitting with a surplus cash, then normally what we recommend is you set up a holding company structure where the cash can then be paid out as dividends to the holding company. Holding company can set up a subsidiary. The subsidiary can then start investing into properties and other assets. The main reason why somebody would set up a holding company is, first of all, to protect the assets. And so a lot of the time, trading businesses, they are susceptible to certain risk. And so there could be legal risk, there could be there could be problems with customers. So all they want to do is protect whatever assets they've built in the trading company. That's usually the case where a holding company structure could work beneficial. The other bits where a holding company could come into play is if you've got multiple activities happening. So for example, you've got property development business, and then you want to have a rental business as well. So usually putting them into a holding company structure is better, because transfers between the intercompany transfers can be done without having any impact on capital gains tax or STLT. So it depends upon what activities you're planning to do and what your long-term goals are. And based on that, then we can advise whether holding company structure is suitable for you or not.
Sure, sure. Thanks. Thank
So again, the similar background question.
Yeah.
How easy or difficult to move a property from a personal name to company name or LLP by paying minimum taxes transaction? Can we do this for a small portfolio and save some money? Additionally, how long does it take moving one property, portfolio to limited
Yeah.
company, and cost?
Yeah. So I guess transferring from your personal portfolio into a limited company, as I said in my initial introduction, there are two costs we have to look at. One is the capital gains tax, and the other is stamp duty land tax. With capital gains tax, again, if the property is your main residence, then most likely, if it was your main residence, then most likely there's a computation involved, and you can see because of the principal private residence relief, the CGT impact could be much lower. Obviously, but transferring a small portfolio into a limited company will definitely have some sort of capital gains tax for you to consider. So that's the first consideration that you'll have to give. Secondly, there will be stamp duty land tax as well, because when you're transferring the property into a limited company, as I mentioned in my previous discussion, the deemed market rules will apply, and there will be stamp duty land tax for you to pay as well, unless the property portfolio is held in a partnership. So as far as the cost is concerned, we have to look at the numbers and we have to do the computation to see how much much CGT and stamp duty you will end up paying if you were to transfer the properties into a limited company versus the benefits that you will get by transferring the properties into company. The benefits could be in the form of, first of all, in the form of income tax. If you're a higher rate taxpayer, additional rate taxpayer, we need to remember that most likely, depending upon the profits, the company is most likely going to pay 19% corporation tax as opposed to the 40 or 45% tax that you will pay on your property portfolio. The other thing is the cash that you're building or the tax savings that you're achieving can then be used to grow your property portfolio. So there won't be a very easy way to transfer the properties into a limited company without paying any taxes, unless we can, unless you have a substantial portfolio which is actively managed. That's when incorporation relief could come into picture. LLP, on the other hand, limited liability partnership, with the LLPs or partnerships, they are transparent as far as taxes are concerned, which means the partnership doesn't pay any tax. All the tax implications are for the partners. So if you are setting up an LLP where all the partners are connected to each other, their family members, spouses, children, then in majority circumstances, there won't be any stamp duty tax to pay when the properties are going into the partnership because of the Schedule 15 exemption. As far as capital gains tax is concerned, we have to see how the you can structure the capital change ratio in a way that there's no capital gains tax for you to pay. So especially if you already own properties with your spouses, the capital sharing ratio can be based on the existing portfolio where there's no transfer of capital to the partners in the partnership. And then, as I mentioned, as far as your income sharing is concerned, that the partners can basically decide or mutually agree from time to time on how they want to split the profits. But then again, that has to be dependent upon the time each partner is spending, what sort of activities they're performing for the partnership to avoid any challenges from the revenue.
Perfect. Thanks very much. Anjali has asked, should Form 60 be submitted in the first 60 days of the purchase for putting the trust in place?
So is it on the, should Form 60 be submitted? I think she refers to Form 17. That's what Form 60 I've not come across, but looks like it's a question around Form 17 in the first 60 days of the purchase. Yeah, so if you are buying the property with a spouse or civil partner, and then if you want to split the rental income in any ratio other than 50-50, then you have to submit the Form 17 within 60 days when you purchase the property, or otherwise, whenever you decide to split the income in a different ratio, then the Form 17 has to be submitted within 60 days when you decide the split.
Perfect. Thanks. Question from Victoria. What is the best way forward? Is it better to buy in your own name than have declaration of trust at 99% and 1%, or buy as a tenants in common at 99% versus 1%?
Yeah. So I guess the second approach is better, because if you're buying the property, when you're buying the property, if you're buying it as tenants in common, then you can decide the ratio that you want to have the property as 99:1, which means that all you'll have to do is, once you purchase the property, submit a Form 17 to HMRC and show them the deed which your solicitors have drafted. Now, once you've purchased the property, and after that, if you transfer after that, you create a declaration of trust to distribute the profits as 99:1. Now, so technically, there won't be any capital gains, because once you purchase the property, then we have to consider the capital gains tax as well as stamp duty, land tax. Now, with CGT, again, any transfer between spouses will happen at no gain, no loss, which means there's no capital gains tax implications. And anyways, depending upon when you do it, if you're doing it immediately, then most likely the property is not appreciated in value. So CGT is not an issue. The only problem is stamp duty, land tax, because once you purchase the property in your name, you would have paid the STLT. And after that, if you create a declaration of trust to transfer majority of the interest into your partner's name, for example, if you're transferring 99% to them, and the property does have a mortgage, then that would be considered as a deemed consideration for STLT purposes, and then you might be subject to, the transfer may be subject to stamp duty, land tax. So my recommendation would be, if that can be done in the first instance itself, when you're buying the property, that's perfect. Obviously, for mortgage reasons, if you can't do that, then definitely you need to discuss with your solicitors. I'm sure there's a way around where you can still be on the mortgage deed, but hold the property as 99:1. Right.
Thanks. Rachin, please go ahead with your question.
Yeah, the question is something continuation with the question, the answer was just given. I mean, in case if I'm buying any property with certain low amount in cash, and how then it should be split up. If let's say I'm the principal owner of the property. However, I'm the main source. I'm the earning member of the family also. So how can we split the property into 1 into 99? Could you please explain once again? Like 99% should go to my spouse, so that in future, if I want to put the same property for the rent, we can split the income in such a way so that the minimum tax should come to on the we should come in the minimum tax.
Yeah. So what you can do is when you're buying the property, you will have a declaration of trust, which will state that although you're the legal owner of the property will be held in the ratio 99:1, and then you will supplement this with the form 17, which will be submitted to HMRC. Now, from a lender's perspective, that could be a challenge because if and again you will have to discuss with the lawyers as well, because the lawyer might not be very comfortable drafting a deed which basically says that the beneficial interest of the property will be held as 99:1. So because if you look at the lender is basically protecting from a lender's perspective. According to them, you are the one who is actually buying the property. They've assessed you when they're giving the mortgage. So from a legal perspective, that could be an issue. But yeah, but usually, as far as tax is concerned, the tax will always be based on the beneficial interest, whereas with the lender, it will be based on the legal interest. So the only challenge is if the lenders tomorrow find out that you have transferred the property where the beneficial interest is 99% to your wife and 1% to yourself, then they could kick in the redemption clause. So usually it's better to let the lenders know that from a tax perspective, I want to split the income 99:1 in the favor of my spouse when you're actually buying the property or doing a declaration of trust, for example.
Thank you. And just one more thing to add on it. In case if I'm paying all the amount in cash? I'm not taking any mortgage from any lender.
Yeah, so if you're not taking any mortgage in the name of if you're not taking any mortgage, then probably best is when you purchase the property itself, you can let the solicitors know that the property will be held as tenants in common, where 99% of the 99% of the property in terms of legal and beneficial interest will be held by your spouse, and 1% will be held by you. So that can be done. So if the lender is not involved, then I think it's just a simple deed of trust, which the solicitors will create when you're buying the property.
Thanks, Siddharth.
Thanks, Sid. Anyone got any other question, guys? Yes, Manoj, go for it.
Yeah, so another question is like, if we are, we say, setting up a new company and we don't know the structure, whether it will be a holding company or whether it will be. So, what is the best way to start? Let's say.
So I think the initial thing to do is to keep the structure very simple, especially if you're starting out on your property journey, because holding company is something that you can set up at a later date. Obviously, the cost of that might increase slightly, but the problem that we are seeing these days is if the company is being set up under a group company structure where there's a layered structure, a lot of lenders, they don't want to lend to a company which is actually controlled or where the shares are actually held by another limited company. So again, that has to be discussed by case to case. So for example, if you've got 50 lenders who would lend to an SPV, there are only 10 lenders these days we are finding out who would actually lend to a company which has got a group company structure which is controlled by another entity. So probably in my opinion, it's better to start simple, and then as you grow your property portfolio, depending upon the activities that you undertake, we can always implement the structures to ensure that you're tax efficient as well as you're protecting your assets.
Okay, so it just will be like setting up a new property company, and is it like a property company, something called like propco, opco? Is it two different things like property company and operating company? Is that
So
structure should be done?
So property and opco will again depend upon, as I said, it's the activities which matter. If the property company, if you're just going to do AST, which is a short-term tenancy, then it's better for you to just set up a company, one company, which will be a property company, and it'll be responsible for collecting all the, it'll be possibly involved in collecting rents, etc. But if you're doing service accommodation, furnished holiday lets, then yeah, there could be some potential for you to kind of have a property company which is only dealing with AST, maybe have another company which could be operational, which is managing all your other activities as far as your business is concerned. So as I said, Manoj, it's best to discuss about what your plans are, what type of property you're buying, what your intention are, what kind of activities you'll be undertaking to build a business case, whether there are multiple properties required in order to structure your portfolio.
Sure, sure.
Perfect.
But at least you can start with the simple one and then
Yes,
make it like
yes.
the way. Okay. Okay.
Yes.
Thank you.
Vian, please go ahead with your question.
Yeah. First of all, thanks, Vijay, and said quite informative session. I have a quick question on this. Uh, the plan, I think, so far from the discussion, it seems having that 99-1 may be the better way to do it, tenants in common, because we are assuming that the spouse is earning less.
Yeah.
The way rents are going, the way your spouse could step up tomorrow in the income and fall into 40% bracket. What would be the mitigation? Is anything else we can do now while doing it tenants in common, that tomorrow when we step up into 50K bracket and spouse is also
Yeah.
falling into that, how would we manage it? Thank you.
Yeah, so I guess Form 17 is only there to solve the problem as of today's date. If tomorrow the spouse basically starts earning, falls into the higher rate tax bracket or additional tax bracket, then Form 17 might not be very valuable as far as planning is concerned. And therefore, we need to start looking at other structures when you're setting up your property portfolio, or if you already have an existing portfolio, maybe the future properties that you buy, maybe you can consider buying that through a limited company, or maybe setting, if you've got children who are already major, 18 or above, then you can think about holding the property portfolio with them as well. So there wouldn't be any simple solution after the Form 17 has been done, especially if your position changes, because what we are looking at is the solution that we're talking about is based on the current position. If your future position changes and you're already aware about that, then probably Form 17 is not the way to go forward for you.
Kevin, thanks for it. But again, I know the situation because rents are stepping up, spouses are stepping up. So I know that's going to happen in next few years. So do you think there's nothing else we can do apart from taking a hit of moving it to a company? Or is there anything we can do still to mitigate the risk? Thank you.
So property management company is what we discussed about. So you could set up a property management company, which could be responsible. So I think Manoj floated the idea of OpCo. And so the company could actually take up the responsibility of fully managing your properties. So it could be responsible for collecting rents, finding tenants, taking care of the repairs and maintenance, and in exchange, the company could actually charge you a commercial fee. Whatever fees that you pay to the company will again become a cost for you as a landlord. And then for the company, basically the company will have to pay corporation tax on it. So the savings might not be very huge, but still it will definitely result in some savings. Yeah.
I get it. Sorry, I'm not stretching it, but I did heard about this solution. And as my understanding from previous discussions with other people, they suggest if you're opening that company, you must be handling properties more than your own property. Otherwise, it's seen as an tax avoidance. Because if you open up a company just to manage your property, MLC is the way you are avoiding the tax. So is that company route is still legal because it has to have other property involved? Then am I right in saying it? And if that's the true, is it a viable solution? Thank you.
So again, any activity or company that you open, there has to be some commercial basis for the company to open. So I wouldn't disagree that if the property company is only be open to manage your properties and there's no business case that you want to take other properties as well in the future, or you're intending to buy more properties through this company, then definitely revenue could challenge. But again, it depends upon the contracts that you have in place, what activities the company is undertaking, what potential future plans that you've got in order for the company to actively engage in managing other people's business as well, or maybe engage in activities where it'll be buying its own property portfolio in the future and then renting it out. Yeah.
Yes, that's all from me. Thank you.
Perfect, Sid. Thank you very much, guys. We have to finish this session. We are over the time, but it's okay. If you can still view this session, there is a recording request here, and Human Chen has asked, "Do you advise on setting up growth free share?" If you could
Yeah.
answer the last question, please.
So that's more relevant as far as inheritance tax is concerned. So I guess what Human Chain is referring to is inheritance tax planning. So when you're initially setting up a company, you could plan for your future as well. So you could set up a family investment company where you could have alphabet shares, where at least your shares could be set up as freezer shares, which means any growth in capital which happens from the property doesn't really fall into your estate, which means you will have freezer shares and you can give growth shares to your children, which means any capital growth that happens in the property portfolio moving forward will only belong to the children. So that way you can optimize your inheritance tax position. So we can definitely advise on that area as well. But that's more to do with inheritance tax rather than the existing property portfolio. But yeah, if the structure is set up correctly, then you can definitely optimize your inheritance tax position as well.
That's brilliant, Sid. Thank you very much. Thanks very
Yeah.
much, everyone, for joining us. We'll be having a session next month as well. Number of